Hey there, future Wall Street wizards. Ever wondered how regular folks become millionaires? Or how companies like Apple and Amazon grew into giants? The answer, my friends, lies in the exciting world of stocks and shares. Think of the stock market as a giant marketplace where pieces of companies are bought and sold. It's like a bustling bazaar, but instead of spices and fabrics, you're trading ownership in some of the world's most innovative and profitable businesses. Sounds intimidating? Don't sweat it. This guide will equip you with the basic knowledge to navigate this jungle and potentially grow your wealth. We'll demystify the jargon, break down complex concepts, and empower you to make informed investment decisions. So, buckle up, and let's embark on this exhilarating journey to unlock the secrets of the stock market. But before we continue, if you like this video, please remember to share it with your friends, hit the like button, subscribe to the channel, and then watch some more of our videos. First things first, let's define what we mean by stocks and shares. In the simplest terms, they're essentially the same thing. Think of them as tiny pieces of ownership in a company, like slices of a delicious pie. When a company wants to raise money for expansion, research, or other business ventures, it can issue stocks. These stocks are then bought and sold on stock exchanges, with each share representing a small fraction of ownership in the company. So, when you buy a share of Apple, for example, you become a part owner of the tech giant, albeit a tiny one. You're essentially betting on Apple's future success and hoping to profit from its growth. Now that we've got the basics down, let's dive deeper into how this ownership thing actually works and what it means for you as an investor. Imagine you own a bakery that makes the most delicious apple pies in town. Business is booming, and you want to open a new location, but you need capital money to make it happen. Instead of going to a bank, you decide to sell slices of your bakery pie to the public. These slices are your company's stocks. People who believe in your bakery's potential buy these slices, becoming shareholders. As a shareholder, you're entitled to a portion of the bakery's profits, distributed as dividends, and you get a say in certain company decisions through voting rights. The more slices, shares you own, the larger your piece of the pie, ownership, and potential rewards. That's the beauty of stocks. They allow you to participate in a company's growth and success, sharing both the profits and the risks. Now for the part everyone's curious about, the money. Investing in stocks comes with the potential for substantial returns. When a company performs well, its stock price generally goes up, increasing the value of your shares. If you decide to sell, you could make a tidy profit. But remember, with great potential reward comes inherent risk. Just like your favorite sports team, companies can have good and bad seasons. Economic downturns, industry disruptions, or simply poor management can cause stock prices to fall. That's why it's crucial to do your homework before investing. Thoroughly research the companies you're interested in, understand their business model, and assess their future prospects. Knowledge is power, especially in the stock market. Section 5. Legends of the Market. Apple and Amazon's stock stories. Let's look at some real-world examples to solidify our understanding. Apple and Amazon, two titans of the tech industry, have consistently rewarded their early investors with astronomical returns. Apple, once a struggling computer company, reinvented itself with the iPod, iPhone, and App Store, becoming a global behemoth. Those who recognized Apple's potential and invested in its early years have seen their money multiply exponentially. Similarly, Amazon, starting as an online bookstore, has transformed into an e-commerce giant, cloud computing powerhouse, and entertainment mogul. Its stock price has skyrocketed, enriching countless investors who believed in Jeff Bezos's vision. However, it's not always sunshine and rainbows. Remember companies like Blockbuster or Kodak? They failed to adapt and innovate, leading to their eventual downfall and significant losses for their shareholders. These examples highlight the importance of informed decision-making, diversification, and a long-term perspective when it comes to investing in the stock market. Section 6. Demystifying the jargon. Investing analogies. The world of finance is notorious for its complex jargon, but let's break it down using some relatable analogies. Remember the bakery analogy from earlier? Think of market capitalization as the total value of all the bakery's slices or shares combined. It's like determining the total worth of your bakery based on the price of each slice. Earnings per share represent the bakery's profit divided by the number of slices. It indicates how much profit each slice of your bakery generates. Price-to-earnings ratio, or PE ratio, is like comparing the price of your bakery's slice to the profit it generates. It helps investors determine if a stock is overvalued or undervalued. These are just a few examples of how we can simplify complex financial terms using everyday analogies. Understanding these concepts is crucial for making informed investment decisions. Section 7. Buying and selling stocks. Your first steps. Ready to dip your toes into the stock market? The process is more accessible than you might think thanks to online brokerage accounts. These platforms act as intermediaries, allowing you to buy and sell stocks with ease. First, choose a reputable online broker that aligns with your investment goals and risk tolerance. Once you've opened and funded your account, you can start researching and selecting stocks that pique your interest. You can place market orders, which execute your trade at the current market price, or limit orders, which buy or sell shares only when the price reaches your desired level. Remember, successful investing is a marathon, not a sprint. It's about making informed decisions, exercising patience, and staying the course even when the market gets bumpy. Section 8. Don't put all your eggs in one basket. The power of diversification. Imagine putting all your savings into a single stock, only to see it plummet due to unforeseen circumstances. That's why diversification is crucial for mitigating risk in your investment portfolio. Diversification simply means spreading your investments across different asset classes, sectors, and geographies. Just like you wouldn't put all your eggs in one basket, you shouldn't put all your money into a single stock or industry. By diversifying your portfolio, you reduce the impact of any single investment's poor performance on your overall returns. It's like having a safety net for your investments, ensuring that a single setback doesn't wipe out your hard-earned money. Section 9. Beyond the stock market, exploring other investment avenues. While stocks offer the potential for high returns, they're just one piece of the investment puzzle. Other asset classes such as bonds, real estate, and commodities play vital roles in a well-rounded portfolio. Bonds are like loans you give to governments or corporations in exchange for regular interest payments. They're generally considered less risky than stocks and provide a steady stream of income. Real estate involves investing in properties either directly or through real estate investment trusts, REITs. It offers diversification and potential for long-term appreciation. Commodities include raw materials like oil, gold, and agricultural products. Their prices fluctuate based on supply and demand, offering unique investment opportunities. Understanding the role of these different asset classes and how they interact is crucial for building a robust and diversified investment portfolio. Section 10. The final word. Invest smart, live richer. Congratulations, you've now embarked on your journey to becoming a savvy investor. Remember, the stock market can be a powerful tool for building wealth, but it requires knowledge, patience, and a long-term perspective. Do your research, diversify your portfolio, and don't be afraid to seek guidance from financial advisors if needed. Embrace the ups and downs of the market, knowing that informed decisions and a disciplined approach will ultimately lead you to your financial goals. So go forth, explore the exciting world of stocks and shares, and watch your money grow. If you liked this video, please share it with your friends, hit the like button, subscribe to the channel, and watch more of our great videos. Thanks for watching.